Gold prices soared near new all-time price highs this morning and finished with its highest weekly close ever, following overnight attacks by Israel on Iran, with Iran responding today with missile strikes hitting Tel Aviv's city center. As oil prices spike and investors rush towards safe haven assets, rising geopolitical tensions, potential trade disruptions, and mounting economic uncertainty, they're all fueling renewed demand and longer-term interest for gold, silver, and even platinum bullion. 4 days ago, under calmer oil market conditions, outspoken short-term gold bear, Bank of America's head of commodities and derivatives research, Francisco Blanch, described gold needing a shock to induce higher price levels short-term. Well, perhaps this sad recent violence escalation in the Middle East is that shock. Have a listen.
Let's finish on something that's gone more expensive. Gold, 33.20, up by more than 26% now for the year. What's the call from you and the team?
So we think there's been a bit of a double top in the first half of the year. So we think maybe second half we need to see a real shock for prices to break away from where we are. And we have a $4,000 target, which we think may be a 2026 story. But if you look at the action in the precious metals, it's really coming from other areas. It's coming from platinum, which is really where things are starting to move in a big way. We've seen 1200 hit this morning, and potentially we're going to go higher in platinum. We think platinum will trade well ahead of palladium, which is also being dragged along, and even silver. Silver is now 36 and change, and heading up to 40, we believe, right? So gold's had a good run. Now we're getting the rest of the precious metals, and then based on whether geopolitics and maybe the U.S. budget deficit situation worsens, then we'll have another leg up. But I think second half of the year might not be as great as the first has been for gold.
The fundamental truth of the matter is none of these three precious metals needs acts of war or further violence to escalate their price as time proceeds. We'll get further into platinum's recent price explosion later in this week's SD Bullion Market update, but first, the ECB and the Financial Times reminded the world this week that gold is now the second largest reserve held by collective governments around the world, having blown past the fiat euro well over a year ago, yet now this news is only being publicly disseminated so broadly. The fact that gold as a percentage of government reserves is sharply rising of late, it's not an anomaly. It's actually returning to the historical norm, where upwards of 40% or more of sovereign savings are official gold reserves held in physical gold bullion. In the early 1980 gold bullion bull market mania, the percentage of reserves held in gold rose towards 65%. And now if history were to again rhyme in time, that's five-figure fiat US dollar price per gold price potential. Now when we look at this chart, what is the gross historic anomaly is the proliferation of full fiat currencies and the bonds that bind them claiming to be safe haven assets, all while likely staring down decades of secular bear market to come on paper promise piles. Billionaire investor Jeff Gundlach spoke to some of these very same points this week.
We have a tremendous paradigm shift that's going on, where money is not coming into the United States, where the long bond is not a flight to quality asset. Gold suddenly is the flight to quality asset. People, I think Costco is selling gold retail and they can't keep it in stock. And gold has gone from, it was living at $1,800 an ounce not very long ago, and once it broke above 2,000, it was just straight up. And now it's basically a third of 10,000. 3,333 and 33 cents it was actually when I looked at it yesterday. So I think gold is a real asset class. It's no longer for lunatic survivalists and wild speculators. It's viewed as an asset class, and central banks have been accumulating gold. Gold was stuck in the mud because for a decade or more, central banks were selling it down. They've bought it all back.
So are you buying gold?
I've owned gold since it was $300, and I also own some gold miners personally. But they bought it all back. It's amazing. They sold it at like $300, $400, and they're buying it back at $3,000. See, central banks are not very good long-term investors.
Now, before the 2008 global financial crisis woke the world up to the fragility of this current financial system, mostly European central banks and other pretend financial know-it-alls decided to all collectively up and sell some 4,000 tons of gold priced anywhere from over half to about 1/7 of the current spot price of gold closing this week. Now, any studied gold market analyst also knows since the 2008 financial crisis, both Russia and China have been out mining gold versus most of the rest of the world, China having led the world in terms of gold production since the year 2007 to last year, 2024. Russia is now in second place. Goldman Sachs has an ongoing London gold over-the-counter chart. It looks like it throws darts at how many tons per month China is pulling from that venue. Well, here's the bigger chart that matters more long-term. China has literally been buying and importing gold tonnage in size not seen since the great USA gold reserve importations spanning World War I and World War II combined. It was this great green-colored pile, representing our then over 20,000 tons of gold reserves, that helped us establish the old Bretton Woods Agreement and give us US dollar dominance that we still have today. The U.S. Treasury promise piles that have daisy-chained ever since, they're going to be getting accounted by gold as time proceeds. The emerging world is already showing by its actions that the world that we are likely to be living in again in time is one that is reserved mostly in gold.
Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates.
And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with gold and silver IRAs. Learn more at sdbullion.com/IRA.
The spot silver and gold markets traded mixed on the week, with silver moving lightly up sideways, whereas Middle Eastern missile launching caught a safe haven bid for gold. The spot silver price closed at $36.30 an ounce bid, and the spot gold price had its highest weekly close ever at $3,433 an ounce bid close. The spot gold silver ratio rose on gold strength relative to silver this week to close mid-94. Commercial bank bullion trading desks had their best profitability performance over the past 5 years in the first quarter of 2025. Remember the precious metals Trump tariff scare and the massive London outflows of bullion to the COMEX-NYMEX warehouses at premium? Well, bank desks like JP Morgan, Morgan Stanley, and others reported over $500 million in profits from their activity in the first quarter 2025. The only more profitable, somewhat recent era of data was the 2020 COVID bullion rush out of London into COMEX, which produced over $1 billion in profits for JP Morgan's bullion trading desk alone in 2020. Now, from its recent collective peak near 45 million ounces, about 7 million ounces or 15% of underlying gold has outflowed collective COMEX gold warehouses since. Silver COMEX warehouses have barely begun to draw down, although unsecured silver ETFs are catching a bid, especially in India, adding over 8 million ounces this month amongst their collective 15 unsecured silver ETFs and ETPs. Drawdowns from platinum NYMEX warehouses are flashing a warning signal, having been cut down by nearly negative 45% in the last few months alone. And even with today's large price sell-off in platinum and recent margin requirements raising in NYMEX platinum futures trading, the underlying issue appears to be a scrambling physical shortage, judging from recent data out of London. David Jensen highlighted this week. London platinum market indicates the beginning of a squeeze. Paper claims for some physical metal available for delivery. David Jensen, June 12, 2025. On June 11, 2025, metal analyst Rob Gottlieb reports that 1 month implied lease rates in London have hit 24.5% for platinum. This lease rate indicates the potential onset of a squeeze for physical platinum in London. At the same time, June 11, 2025, platinum trading volume in the CME COMEX market hit a new all-time high, 86,717 contracts of 50 ounce each. See the red mark in the bottom panel of Figure 1 below. The London Platinum and Palladium Market, LPPM, publishes even less data than the London Bullion Market Association, LBMA, for gold and silver. We can only guess as to how much platinum resides in London vaults. We can see from the high and rising lease rates that there is increasingly not an adequate amount of platinum available for delivery in London. Best regards, David Jensen. Finally, as we started this week, there are more bank and commodity research desks calling for silver potentially running towards 40 an ounce spot in the not too far future. We can add Swiss bank giant UBS as another bank calling for $40 an ounce silver. And this week, TD Securities' Daniel Galley made the case for silver to climb based on silver's bullish fundamentals he's been pounding the table over for some time now.
While gold prices have been in the spotlight, silver prices have also rallied and are near its highest level in almost 13 years. Daniel Galley, senior commodity strategist with TD Securities, joins us now to discuss. And Daniel, welcome back to the show on very interesting times.
Yeah, thank you for having me.
All right, so as I mentioned, it's very interesting moves in the silver market. Now, you say we've been seeing a price breakout. What's happened?
Yeah, what's interesting, right? Right now, the silver market is buzzing with this excitement because prices broke through $35 an ounce. That's been a range that's been very difficult to break through over the last several years. And the last time silver prices broke through this level, we traded $50 an ounce in a matter of weeks, within 6 weeks. So, of course, the excitement is building. We think this has been a long time coming. And in fact, we think the current market structure favors these kinds of mini squeeze events going forward.
Oh, okay, so walk us through some of the mechanics behind such moves. And we're looking at a bit of a global imbalance between the big trading hubs in London and New York, correct?
Yeah, correct. That is part of what has caused the imbalance in silver markets right now. Walking you through how this process has worked and how we think it might work going forward. The breakout itself, when we crossed through that $35 an ounce level, was a futures-led breakout. It contrasts with what you might expect, given that we're now 5 years running into a structural deficit. That deficit has eroded physical inventories, and you would expect such a breakout to be led by the physical side. That hasn't been the case, and as a result, it suggests more speculative activity in silver markets, which are or more difficult to forecast what might occur as a result of them. That being said, even though the breakout was futures-led, it might begin to change market psychology, right? The fact that last time we broke through this level, we rallied very substantially thereafter, might start to attract subsequent ETF inflows. Those ETF inflows are increasingly draining what little is left in the world's largest bullion vaulting system for silver out of London. Right, you have to think about this massive imbalance that has occurred as a result of the threat of tariffs earlier this year. A tidal wave of metal moved from London into New York because the relative prices between New York silver and London silver incentivized that move of metal. We're now left with a market structure in which London is critically scarce. There's less silver that is freely available for purchase in London than is typically traded on any given day. And meanwhile, you have this oversupply in New York, and yet London markets aren't pricing that scarcity, and the markets as a whole aren't pricing the incentives required for the metal to flow back to where it's actually physically traded. And this structure, we think, is going to catalyze a series of rolling mini squeezes, as we've called them, that should support a higher trend in prices.
Okay, now that's the supply side. What about the demand side? What are you seeing there?
Yeah, I mean, demand's doing just fine, right? The one thing that I will say since the threat of the trade war became more apparent is that most analysts out there expected a downturn in demand for raw materials, a downturn in the global economy, and we've not seen any sign of that just yet. Our proprietary gauge of broad commodity demand growth is now at the same levels that it was prior to Liberation Day. It's hard to know whether that's being unduly influenced by stockpiling and front-loading of demand, because the world still remains uncertain how the tariff outlook will evolve. But for the time being, demand is doing absolutely just fine.
Okay. Now, you sort of talked about the rising trade barrier. What about the scenarios that may play out from silver from here?
Yeah, so again, right, there is this major imbalance in where silver is physically located. There's only really three possible scenarios that we could see from here. One is the imbalance isn't resolved. That's the current state. In the current state, because physical silver is mostly traded out of London and there is a lack of availability, then firstly, the market will become increasingly illiquid, such that any demand for physical out of London will have a bigger impact on the price. Secondly, this silver that's available there is going to be increasingly concentrated among fewer market participants. And again, that fuels more liquidity, and that's really what drives our view of rolling mini squeezes going forward. The other two cases are, well, how do you catalyze, or how does the market create an incentive for silver to flow back from New York, where it's ample, into London, where it's scarce? Two main ways that could happen. One is you have to create an increase in supply of futures. The reason that would catalyze this, it would catalyze this transportation arbitrage by advent of London prices being higher than New York prices. The interesting part about that is that we just went through a major liquidation event. Right, speculators, whether they're algorithmic traders, discretionary traders, in the aftermath of Liberation Day, we saw large-scale, massive liquidations from those cohorts, and that wasn't enough to catalyze the supply of futures required for this to occur. So what we learned from that is really the third option is what the market will have to rely on to address this imbalance. The third option is ultimately a rise in the price of London relative to the futures. And that goes back to our view of this successive series of rolling mini squeezes that are actually probably required to address this imbalance.
Okay, so given the scenario and given where we are, where we see silver prices right now, what does this mean for the prices going forward? Do you see further push higher for silver prices?
Yeah, absolutely. We forecast higher silver prices on the horizon. We think that we could trade $40 an ounce before the end of this year.
Another silver bull in the face of continual supply deficits has spoken. Apparently, platinum is currently showing silver the way forward. I'll take advantage of this weekend sale on 1 ounce American Silver Eagle coins priced below 40 an ounce in any quantities while supplies last. That's going to be all for this week's SD Bullion Market Update, and as always, to you out there, take good care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.